Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Today, we're going to be talking about hybrid funds. As you all know, these funds invest in equity and debt. Dhiren, do these funds automatically rebalance the portfolios and maintain the required asset allocation, as has been communicated about these funds?
Yeah, broadly, the kind of funds which most investors should be using, they have a defined allocation. They invest in equity and debt in a certain proportion. There is a set of hybrid where the discretion goes to the fund manager, that he decides where the money should be, whether it should be fully in debt, fully in equity, or 90% in equity, 10% in debt. So that is his choice. Those are called asset allocation funds. But we are not talking about them. I look at the utility of hybrid funds as any investor who is getting started should start only from these funds.
Okay.
No investor should for all your long-term money, this should be the starting point. We keep saying that.
Okay, and there is a reclassification that we're talking about, and I would like you to touch upon that, because this reclassification has brought in a lot of subcategories to the hybrid funds within the hybrid fund space. So, can you demystify this new hybrid, the new hybrid categories that have come in, and help us to understand how relevant these are for us?
No, all kind of hybrid funds existed before.
Okay.
The reclassification has just formalized it. The reclassification has just gone about, organizing, stating it with clarity. There are 5-6 kind of hybrid fund. One is what I was referring as the asset allocation fund or the arbitrage fund.
Okay.
But they are not mainstream fund. I think, the starter funds, the funds which investors should use, should be the fixed allocation funds. There are funds which are 25% equity, 75% debt.
Okay.
These are meant for, a very conservative investor. Then there are funds which are equally into equity, equally into debt. And they keep rebalancing often. It could be on a daily basis, it could be on a weekly basis. So that is a fairly stable vehicle. And then you have, the old erstwhile balanced fund, which is now called aggressive hybrid fund. They are 75% equity, 25% debt. It is a conservative take on equity. It does not scare an equity investor, though it is dominantly an equity fund. So these are 3 primary categories which any investor should start with. Rest of them you can safely ignore, because they are there for legacy reason. They are useful for some sophisticated investor or somebody. I think most investors can do without them. But these 3 are very useful categories. They are meant for people who have no exposure to market-linked investments, because Indian investor, there is historical experience of investment is that I will invest, how much will I get? This is the starting point. Right. Indian investor has been historically a fixed income investor. And the moment you get into something where you say that I will invest, but how much do I get? And your answer is that I don't know. Then how scary it can get. Then you say that it can get very scary. It can go down in value substantially. So these are the kind of these hybrids are very useful from that standpoint.
Okay.
It helps you appreciate the market volatility, market link, the lack of guarantee of return, and benefiting from it. So they are. I think anybody who is investing in mutual funds or market linked investment, these are great vehicles to acclimatize yourself with them.
Okay. So what Dhirendra is saying is that there are 3 groups under which the hybrid funds fall in. 1, conservative hybrid. 2, balanced hybrid, and aggressive hybrid. Now, would you like to put an investor like me into these categories, or would you like to explain to our viewers which category they should choose and which category they should fall into?
An investor like you.
Shall we go?
Sorry?
No. Shall we go one by one? Unless you're putting me into some category.
No, I'm not putting you in a spot. But the fact that I have known you for 5-6 years, so you don't fall into any of these categories. Just that I have initiated you into mainstream equity funds by now.
Yes.
But Yes, I would like to go one by one. The conservative hybrid funds, the funds which invest a maximum of 25% into equity,
Yeah.
remaining into fixed income, they are very stable. They don't give you nasty surprise. They don't go down in value by 30-40%. They are also useful for income investors, because many investors, they realize that they have to optimize their return.
Okay.
Fixed income return will not be good enough. So these vehicles are good to uh, optimize your fixed income. You can also derive periodic income from them without substantial loss of principal in the interim. Of course, you have to be careful about the withdrawal rate. And
So, in a nutshell, conservative
very
hybrid,
conservative investors,
for regular income.
for regular income as well. But more importantly, when you have to invest for regular income, one caution needs to be exercised, which is, if you have 10 lakh rupees, 50 lakh rupees to invest, don't invest at one go, even in these funds.
Right.
Because reducing the possibility of catching a market high with your 25% allocation to equity through these funds is also worth avoiding.
Yeah.
So
So SIP is the
so SIP for 6 months, 1 year is also important here when you are investing a large sum of money to derive income.
Okay. If we talk about the balanced hybrid, where 50% is equity, who falls under it and how do they get?
These are wonderful vehicles. Unfortunately, we don't have too many funds which are stated like that, because most of the funds in this category officially are, accidentally falling into that, the children fund and the retirement funds. But I see a great promise in this category, because this is a fund where, if the market is volatile, sometime equity does well, sometime fixed income does well, their ability to rebalance it. And I think, in your retirement, all said and done, we become little less, we are averse to risk. We get uncomfortable with big slide in value, decline in value. So these are, balanced vehicle. And in a market where they also stand out for their performance, many a times they have beaten equity fund, because there is a long phase in the market when equity doesn't go anywhere, but in the interim it will be going up and down. Market has this character. So these funds stand to benefit from that.
Okay. And now lastly, the aggressive hybrid, where 75% is in equity. So who's this investor?
This investor is what you were 5 years ago, who had never invested in equity.
Yes.
And was a long-term investor. Is still in the accumulation phase. He still has 10-15 years to invest. Everybody should start with these funds, not start with a sector fund, which most people get carried away by looking at the recent past performance. So long-term investor looking to invest in equity, they should start here. After 3 years, you should move your money to the multi-caps and large and mid-cap funds.
Okay.
But this is the starting point for all growth investors seeking sizable, handsome return, but investing for the first time.
So if you want to be that kind of investor who's smiling like me sitting today because the Rain's advice has benefited me quite a bit, then go for the aggressive hybrid fund. Correct?
Yeah, sure.
Okay. I'm giving him all the credit for
no, but
whatever little I have.
But most of the credit actually goes to giving advice is easy.
Yeah.
Doing it month after month and not getting
Bogged down by
intermittent decline.
Yeah.
I think that's so you deserve it.
Okay, thank you
For your actions. Yeah.
We now move on to the questions that you send us. And the first question is from Amber, and he says, I'm 28 years old and have already exhausted my ATC limit. Should I invest in NPS to get additional tax benefit, or would it be better to put that money in regular equity mutual funds? In light of the new benefits that have come to the taxpayers,
no,
would you
but
like
I would say that this is something worth availing. If it actually reduces any of your tax slabs, if you're into 30% and 50,000 will actually reduce it. So it depends on that. But still, NPS has improved and equity has actually deteriorated ever since, little bit because of the capital gains tax. So tax save is money earned. Moreover, NPS has improved on 2 counts. One is that the remaining 60% which you'll be withdrawing will be tax exempt. So on tax efficiency, it has improved. The other is that NPS has improved by design as well.
Okay.
Now you can invest, earlier NPS was maximum allocation to equity in NPS was restricted to 50%. Now it can go up to 75%. So invest in NPS and take the highest allocation, and 40% of it will be annuitized.
Okay.
Liquidity is a constraint, but that's fine because the rest of your money is anyway liquid after 3 years.
Yeah. So you're strongly recommending.
I would say that
we
yes,
should
it
get
is worth
into
considering.
NPS. All right. Okay. The next question is from Brij Bihari, and he asks, and many people would be interested in knowing, how can I choose the best mutual fund?
I wish I had a very simple answer to a simple question. I'll give a complicated answer to this because the best fund depends on whether you are investing for the short term or for the long term. And if you are investing for the long term, then is your goal also is to save taxes? Is investing to save taxes besides investing for long term? Then there is another rider. Are you a first time investor? Have you ever invested in a fund? So depending on this, there will be a best fund. If you have never invested in a fund and you are a short-term investor, I will give you the best fund is liquid fund or ultra short-term bond fund. If you are investing for the long run, wanting to save tax saving fund. Investing for the long run, never invested before, and investing for the long run, never invested before, and so start with the balanced fund. Okay. Investing for the long run, invested before, then choose a multi-cap fund. So there are different answers. So there are different best funds depending on your experience and your
requirement
and your needs.
Okay. Age and all doesn't matter, does it?
No, it doesn't matter because you could be 70-year-old and you could be investing for the long term because if you don't have requirement for income, or you could be a very young person and you need to consume that money in 2 years' time for your sister's wedding or buying the car. So that's a short-term investment. So it has nothing to do with age. It has to do with your goal or when you are likely to need the money.
Okay. Dhiman writes in, I have a surplus of rupees 30,000 to invest every year. Which kind of fund would be ideal to invest? My horizon is 15 years. And if you paid attention, Dhiman, to what Dhirendra answered a while back to Brij Bihari, you would have found your answer. Nonetheless, I'm directing it to Dhirendra once again.
Yes, one thing which I don't find in this question is that has he invested before? If you have never invested before, then the 30,000 rupees should start, you should start do your monthly investment. So 30,000 rupees means 2,500 rupees every month. Do your SIP in a aggressive hybrid fund for next 3 years. If you
horizon is nice, actually.
Horizon is nice, but still first 5 years, first 3 years, you should get used to the market linked investments through this. If you will also get a tax benefit by investing this 30,000 because that's the advantage. 30,000 will be deducted from your income every year for computing your taxable income. So if that is a need, then if you're likely to pay taxes or can save taxes by investing in this amount, then invest in the tax saving fund. So balanced fund or tax saving fund, depending on your needs.
Okay. Next question is from Viresh, and he says, I plan to reduce the number of funds in my portfolio from 9 to 5. Should I move my investment from old funds to new funds in lump sum, or should I do it through SIP?
If you have decided on where to consolidate or where to concentrate your investments, you can move it lump sum, because the whole idea of investing in equity in a staggered way is to spread reduce the risk of catching a market high. But you have already taken the market exposure. You are already into equity. Only thing you will have to do is mentally reset that if you are moving your money today, and assuming that your accumulation in the older fund from where you are moving your money is 5 lakh rupees. So tomorrow, if you move your 5 lakh rupee in the new fund, mentally you will be calculating that, okay, my 5 lakh rupee has become 490, or my 5 lakh rupee has become 520 or whatever. But the whole idea of investing in regularly is to spread the risk, and that you have already done with your past SIPs, you can move lump sum.
I have a question that he's talking about reducing it from 9 to 5 or 4. So should he get the 9 that he's reducing spread in the other 4 or 5?
Yeah, that's exactly what he's asking.
Yeah.
That he has already decided that he has 9 funds and he wants to
Bring
focus
them
only on
down
4. So he wants to sell his investments in 5 of them, and he wants to move that money in the 4 which he has
Right.
chosen. So he can do it lump sum.
Okay, fine. Ajaz writes us, what are your views on small and mid-cap funds for the next 3 years, considering the various possible outcomes of the general elections?
Very difficult to answer, but I would say that these funds do very well on a full market cycle, and they are extremely disappointing in a bad market, and they do exceedingly well whenever we look at if you look at 20-year return, 15-year return, 10-year return of small cap and mid caps, they top the charts among categories. They do well. Then and in India, I think that there will be greater opportunity of relatively smaller sized, mid-sized companies attaining higher scale, bigger, better, or more profitable. And their scalability, but they come with a risk. They are more vulnerable in a downturn. So I would say that I don't know about.
Nainad has written, is there any regulation which mandates the fund house to buy equity shares from the new SIP money within a specified time period, or are they free to deploy it as and when they feel?
Every fund has a charter that is there in the prospectus.
Okay.
That what the asset allocation will be, 90% equity, 10% debt, or what could be the maximum fixed income allocation even in an equity fund. So fund manager has a discretion. Most fund managers typically can retain 20% in cash. Many fund managers, equity fund managers, they choose not to invest all their money in equity at all times. Sometimes they have 10, 15%, 20% into cash, cash meaning fixed income. And sometimes they are fully invested if they think that the market is attractive. So they are at freedom. They have reasonable flexibility to maintain. They need not be fully invested depending on their outlook of the market.
Okay. And Rudra says, which category of equity funds would be ideal for a horizon of 20 years?
2-3 categories. I would say that, to keep it simple, multi-caps are the way to go. But multi-caps come in 2-3 form in the current classification too. One is the pure multi-cap category, then the larger mid-cap category, which you can also, and the value funds, which are also multi-cap, they have a different strategy. So these 3 funds to have a low maintenance, simple portfolio. You can also build a different kind of portfolio. If you have been used to the market, you are going to invest for 20 years. You will actively review your investments every 2-3 years. Then I think, one should have 50% money in these multi-caps and 50% money in mid and small cap funds too, because they will enhance your return. But that will require, making sure that you have chosen the right fund and reviewing and making changes every 2-3 years.
Okay. Dhirendra, that's all we have in today's program. Thank you so much for answering the queries of our viewers. And as Dhirendra always says, please continue to invest regularly. And this is the new year, 2019. So make sure you make smart investments and continue to see Investors Hangout. Bye for now.